Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if companies are building castles in the sand or solid foundations for the future. Today we are digging into Forestar Group Incorporated, a company that sounds like it's all about trees but is actually deep in the business of building homes. So what is the big picture? Forestar Group Inc. is a company that primarily focuses on developing land and turning it into residential lots for home builders. They are essentially preparing the ground for houses to be built. Today we are looking at their quarterly report for the period ending the 31st of December 2025. Let's start by looking at the company's financial snapshot, the consolidated balance sheets. As of the 31st of December 2025, Forestar had total assets of about $3.1 billion. A big chunk of this is real estate, valued at almost $2.9 billion. This shows us their core business is tied up in the land they are developing. On the other side of the coin, their total liabilities are around $1.4 billion. This includes things like accounts payable and, importantly, debt, which stands at a little over $793 million. In terms of equity, they have common stock, additional paid-in capital, and retained earnings contributing to a total equity of about $1.78 billion. This means the value of the company that belongs to its shareholders is quite healthy. Now let's see how they performed financially. This is the consolidated statement of operations, basically their profit and loss for the quarter. For the 3 months ending the 31st of December 2025, Forestar reported revenues of about $273 million. This is up from about $250 million in the same period last year. That is a nice increase in their top-line sales. However, the cost of their sales also went up significantly, from around $195 million to $218 million. This means that while they sold more, it also cost them more to make those sales. Ultimately, their income before taxes was $20.8 million for the last quarter of 2025, which is slightly down from $21.9 million in the same period of 2024. This indicates that while their sales are growing, their costs are eating into profits. Net income came in at $15.4 million compared to $16.5 million a year earlier. This translates to basic earnings per S-share of 30 cents, down from 32 cents last year. So while they are selling more, their profit per S-share has seen a small dip. Looking at the consolidated statements of total equity, we can see how the company's equity has changed over time. As of the 31st of December 2025, their total equity was just under $1.8 billion. This is an increase from the end of the previous fiscal quarter, which was about $1.76 billion. The main driver here is the net income for the quarter, which added $15.4 million to their equity. Now let's talk about cash, because that is what keeps the business running. The consolidated statements of cash flows. For the 3 months ending the 31st of December 2025, Forestar used $157 million in cash from its operating activities. This is a significant amount of cash outflow. A big reason for this is the increase in their real estate assets, meaning they are investing heavily in new land and development projects. This is a healthy sign of growth and investment in their future. On the flip side, they saw an inflow of cash from an increase in earnest money deposits on sales contracts, which is basically money customers put down for future lot purchases. This sounds positive for future sales. In investing activities, they used a small amount of cash, about $0.1 million. This suggests they are not making major investments in property or equipment beyond their core land development business. Financing activities show a cash outflow of about $10.4 million. This was mainly due to repaying a note payable. Last year, they actually had a cash inflow from financing activities, which means they borrowed money then, and now they are paying some of it back. The first note, basis of presentation, tells us how the financial statements are put together. Forestar became a majority-owned subsidiary of Dr. Horton, incorporated in October 2017. Dr. Horton is a very large home builder, and Forestar's business is to supply lots to them and other builders. As of the 31st of December 2025, Dr. Horton owned about 62% of Forestar. This is a really important relationship to keep in mind, as it likely influences Forestar's strategy and business operations. Diving into Note 3, Real Estate, we get more detail on what they own. Developed and under development projects make up the bulk of their real estate holdings, a little over $2.6 billion. They also hold land for future use, about $173 million worth. It's interesting to note that this land held for future development is often under contract to be sold to Dr. Horton with a profit margin built in. This shows a clear strategic link between the two companies. Let's look at their debt situation in Note 7. Forestar has senior notes outstanding. They have 5.0% senior notes due in 2028, totaling almost $300 million, and 6.5% senior notes due in 2033, totaling close to $500 million. This means most of their debt has fixed interest rates. which can be good in a rising interest rate environment as their interest costs won't balloon unexpectedly. They also have a large revolving credit facility of $665 million. As of the 31st of December 2025, they had no outstanding borrowings on this facility, but they did have $57.4 million in letters of credit issued. This means they have a lot of available borrowing power if they need it, which is good for liquidity. Moving on to note 11, about commitments and contingencies, we see some important information about potential legal issues. They mention a derivative complaint filed by a stockholder against Dr. Horton and some Forestar directors related to lot sale transactions between the two companies. Forestar disputes these allegations, but the outcome is uncertain. They also mention a lawsuit from the Maryland Department of Environment regarding stormwater compliance issues. While Forestar doesn't believe these will have a material impact, it is always worth noting potential legal entanglements. Note 12. Related party transactions is crucial because of the Dr. Horton connection. Forestar has a shared services agreement with Dr. Horton for administrative and other services, and Dr. Horton is a major customer in the 3 months ended the 31st of December 2025. Forestar sold about $183.8 million worth of lots to Dr. Horton. It is clear that Dr. Horton is a very important partner and customer for Forestar. The report mentions that land held for future development is often under contract to sell to Dr. Horton at a price equal to its carrying value plus an additional 12 to 16% per year. This is a crucial part of Forestar's business strategy. In Note 13, Fair Value Measurements, we see how Forestar values its financial assets and liabilities. Their debt is valued at just over $810 million at the 31st of December 2025, which is slightly higher than its carrying value. This suggests that market interest rates might be slightly lower than the rates on their debt, making the existing debt more valuable in the market. Now let's dig into the management's discussion section, which is where the company explains its financial performance. Here, they confirm that revenues increased by 9% due to higher lot sales and tract sales. However, they also highlight that costs have gone up, impacting their pre-tax operating margin. They mention that new home demand is being affected by affordability issues and cautious consumer sentiment. Home builders are offering incentives to boost sales. Forestar's focus is on developing lots for affordable homes. They also note that while supply chain issues have eased, getting municipal approvals is still causing delays and development costs remain elevated. Looking at the number of lots sold, they sold 1,944 lots compared to 2,333 lots in the prior year. That is a drop in volume. However, the average sales price per lot increased significantly, from about $105,500 to $121,000. This is why their revenues still managed to increase despite selling fewer lots. They are selling fewer but more valuable lots. Revenues from lot sales to Dr. Horton decreased from $217.4 million to $183.8 million. However, sales to other customers jumped from $28.8 million to over $51 million. This shows Forestar is diversifying its customer base beyond just Dr. Horton. They discussed that cost of sales increased due to higher revenues, and importantly, they did not record any impairment charges this quarter, which is good news. They also mentioned that interest incurred on their debt increased, reflecting higher borrowing levels or rates, but a good portion of this interest is capitalized, meaning it is added to the value of their real estate assets rather than expensed immediately. SG&A expense was fairly stable, but as a percentage of revenues it actually decreased. This is a positive sign that they are managing their overhead effectively as their sales grow. Finally, let's look at liquidity and capital resources. Forestar has a healthy amount of cash and a large available credit line. Their debt to capital ratio is around 30.8%, which is considered manageable. They aim to keep this ratio below 40%. This indicates they are not overly burdened by debt. The forward-looking statement section is a standard legal disclaimer, but it highlights a lot of risks they are concerned about. Things like the effect of Dr. Horton's controlling ownership, economic conditions, interest rates, supply shortages, and regulatory changes are all listed as potential challenges. It's a good reminder that the future is never perfectly predictable. Now, looking at Forestar's report, the story that emerges is one of growth through increasing the value of lots sold. Even as the volume decreases, their strong relationship with Dr. Horton is clearly a backbone of their business, providing guaranteed sales for a significant portion of their inventory. However, this also creates a dependency. While they are showing success in diversifying their customer base, the larger chunk of their sales still comes from their parent company. The increase in development costs and the impact of affordability issues on home builders are key challenges they face. They are investing heavily in real estate, which is a sign of confidence in future demand. but it also ties up a lot of capital and increases their cash burn from operations. The fact that they are not recording impairment charges is a very positive signal, indicating that their land investments are holding their value. Overall, Forestar appears to be strategically positioned by focusing on affordable housing lots. And their strong relationship with Dr. Horton provides a degree of stability. However, the increasing cost of development and the sensitivity of their homebuilder customers to market conditions are risks they need to manage carefully. The slight decrease in earnings per share, despite revenue growth, calls for attention to cost control. The company is clearly in a growth phase, heavily investing in its future. Alright, that is our breakdown of Forestar Group Inc.'s latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.